Every 4 years, the U.S. presidential elections take center stage, but the impact reaches far beyond politics. For investors, businesses, and consumers worldwide, these elections signal potential shifts in the economy. Let's dive into how this massive event affects markets, industries, and the global economy. Section 1: Economic uncertainty and market volatility. In the months leading up to the election, economic uncertainty rises. Investors and companies are cautious, not knowing which policies might change. This anticipation causes stock markets to fluctuate as financial players react to the unknown outcomes during this period. It's common to see high market volatility. Investors may look to safer assets like government bonds or precious metals, waiting for political clarity before making bigger moves. For many, it's all about minimizing risk until they understand the new political landscape. Section 2: Investment pauses and business decisions. For many companies, the months around an election are a time to hold off on big investments or expansions. Imagine running a business and facing potential regulatory or tax changes. You'd probably wait to make any major decisions until there's a clear path forward. This pause can temporarily slow down economic growth, as companies delay projects, expansions, and hiring plans. For industries heavily influenced by government policy, like healthcare or energy, the stakes are even higher. Section 3: Fiscal policies and government spending. Another critical factor is the possibility of a shift in fiscal policies. Each candidate often has their own approach to taxes, government spending, and economic strategy. One candidate might advocate for increased government spending, while the other might focus on tax cuts or reducing the federal deficit. These decisions directly affect business environments and consumer spending power. For example, tax cuts might stimulate investments and spending, while government spending could drive growth in public sector projects and employment. But both approaches impact the federal budget and national debt differently, shaping the economy in the long term. Section 4: Global trade and supply chains. U.S. elections also have global trade implications. Major trading partners like China, Canada, and the European Union watch closely. Changes in trade policies or tariffs can disrupt supply chains, influence prices, and impact global markets. Imagine a change in tariffs or new trade agreements. It could mean increased costs for imported goods or challenges for U.S. exporters. Many international businesses adapt their strategies to prepare for these potential shifts. Section 5: Sector-specific impacts. Certain sectors, particularly those heavily regulated or funded by the government, feel the impact of election outcomes the most. Energy, defense, technology, and healthcare are just a few examples. Policies on renewable energy, military spending, and data regulations can shift with each administration, directly affecting these industries. Businesses in these sectors often adjust quickly to align with new policies, which can mean rapid growth or slowdowns, depending on the focus of the administration. Presidential elections are a major event, with impacts felt far beyond the White House. From stock market volatility to shifts in global trade and consumer behavior, the economic ripple effects are global. For businesses, investors, and consumers alike, the elections signal a period of adjustment, as each new administration brings its unique approach to the economy. In a world that's increasingly connected, these shifts matter, affecting economies across the globe. Thank you for watching. Stay informed about economic changes that could impact you, and if you found this video helpful, don't forget to like and subscribe for more insights on the global economy.